Hello, everyone. Happy holidays. We're about to enter the Christmas holiday season. And just when you think the market can't get any more interesting, it actually is getting much more interesting just this past weekend. So let me tell you what happened this past weekend. The U.S. Treasury Department Secretary Steven Mnuchin came out with a very interesting memo today on Sunday where he talks to CEOs of the nation's six largest banks. Now, this includes your Bank of America, your Citigroup, your Goldman Sachs, JP Morgan, Morgan Stanley, and Wells Fargo. Now, these CEOs confirmed that they have ample liquidity on their balance sheet and they have cash ready to lend to consumers and also business markets. And according to Steve, he's saying that he sees strong economic growth in the U.S. market with robust activity from consumers and businesses. And this memo to me is actually very bizarre. It's almost as if Steve Mnuchin, he sees something on the horizon that's looming, but it's not quite fully formed. But he's just trying to inspire hope in the market, but it doesn't seem like it's happening. There's nothing. It's almost as if there's nothing to see here. The world is about to blow up. We're about to enter a recession 2019, and Steve is just trying to instill calm in the marketplace, but I don't think it's helping. Here's a very interesting Bloomberg article where it talks about how what Steve Mnuchin is doing to try to calm the market by calling these CEOs on the weekend is somehow going to make the situation better. But no, it's actually making the situation much, much worse. Here's a very interesting quote by Ian Bremmer, where he talks about how the Secretary of Treasury, Steven Mnuchin, calling the bankers on a Sunday to confirm that they have cash to lend. That's not a very confidence boost to the marketplace or to investors at all. It's almost as if people feel that there's something up, but they can't really point their finger to, which I think is actually a liquidity issue. And the reason why there's a liquidity issue at hand that's not fully being addressed at the moment is because the Federal Reserve, they began to roll off about $50 billion of bonds off their balance sheet ever since October 2018. And that's also around the time period where you see the stock market really begin to take a hit. Now, the Federal Reserve will continue to roll off $50 billion off their balance sheet. And this essentially is pulling liquidity out of the economy because the Federal Reserve is no longer taking that $50 billion of dollars from the bonds maturing and reinvesting it by buying new bonds. And usually the Federal Reserve buys new bonds from the banks. So when the Federal Reserve buy bonds from the banks get cash from the Fed. Now, because the banks now have cash, due to fractional reserve, the bank can lend out more money than it really has on its balance sheet. And as a result, that allows more cash in the economy, and that's how the economy can thrive. As you can see here in the chart, ever since October, it's been very weak. And I am very confident that this weakness is due to the quantitative tightening from the Federal Reserve. As you can see here, ever since October, we are down about 18% from the peak. And this is pretty bizarre. I don't think the bloodbath is over yet. I think we're only just getting started. Now, I want you to take a look at the banks. It's very important if we think a recession is upcoming in 2019. It's important to look at the cyclical sectors, and financials is one of them. Now, if you look at Goldman Sachs, Citigroup, Morgan Stanley, Wells Fargo, these have been hit extremely hard in 2018. But this is only just the beginning. Now, something important to keep in mind is that when Lehman Brothers went down, they had about a market cap of $60 billion of market cap, which is equivalent to a Goldman Sachs now. Lehman Brothers' debt to equity was about $30, which meant that Lehman Brothers, when it went down, it had, for every $30 of debt, it only had $1 of equity. So their cushion was dangerously small. So any drop in the value of their assets would have essentially pushed the bank to bankruptcy, just because they have so much debt on their balance sheet. Now, if we take a look at Goldman Sachs, Goldman Sachs currently have about a 3 debt to equity ratio. Compare this to Lehman Brothers at 30 for debt to equity ratio. So just something to kind of keep in mind here. So, overall, I just wanted to kind of share this quick video to show you how liquidity is something to keep a heavy eye on. It's important to take a look at these financial companies to see how much cash they have on their balance sheet. And I think as we approach 2019, this is something that is going to be much more apparent because the Fed, as Jay Powell said, is that he's going to continue to be on autopilot with the Federal Reserve's balance sheet reduction. And this is the quantitative tightening that I'm referring to. So thank you again for watching this video. Hope you learned something a little bit more. Until next time, if you like this video, please drop a like, subscribe. If you put a comment below, I'll be sure to respond back. Thank you again for watching, and take care, you guys. Bye.